So that's the general gist of what we're going to cover. We'll be kicking it off with this pre-65, which coincides with what you'll sometimes hear referred to as the go-go years. So we think of retirement in very similar phases. The go-go years where you're traveling, and oftentimes we're planning for you to spend a little bit more during that time. And then the slow-go years that often begin around your mid-70s. And then sometimes the later years are referred to as the no-go years. So kicking it off with the go-go years, Mike, talk to us a little bit about what are your healthcare options if you retire and you're not 65 yet and can't go on Medicare?
So there's a lot of different things that you can do. Everybody, for the most part, is used to having some sort of offer of employer coverage, so it can be a little bit of a daunting task when you want to leave work prior to Medicare, maybe 2, 3, or more years and out from when you're 65. But the first thing that becomes available if you've had insurance through a large group plan is COBRA. So that's always something that we want to look at first and foremost because you're presented with that option. Sometimes it makes a lot of sense. Sometimes it doesn't make as much sense depending on your situation, but it is available. The other option that you have is you can use the Affordable Care Act, also known as Obamacare, the marketplace exchange plans. Some states have their own individual exchanges, but similar concept. There you can get some tax subsidies to offset your monthly premium obligations. Very helpful as your income may have dropped a little bit as you retired, so we want to be mindful of that. There are some other options that are not on an exchange. There are different sort of privatized plans that you may have. Formerly we had the ability to write underwritten kind of short-term or tri-term plans. Those are not available except for 4 months in duration, so it all depends. I advise not trying to hobble those together to get through a year. It's not a good practice. So you have that, and then there are alternative plans like your Christian healthcare type sharing plans, things like that. So I just like to tell everybody there's always an option. You do not need to work for insurance if your goal is to retire prior to 65. So that's what you can do there.
And Mike, I'm curious about option one. I know, when I started in this business in 95, employer covered healthcare was more widely available. Do you see it that often now for pre-65 retirement?
I see a lot of people still have employer-sponsored health insurance. It does depend if you have 20 or less employees. That can have a bearing on what happens afterwards. So again, you do have that COBRA option to lean on for at least 18 months, in some situations as much as 36. It just depends. But yeah, that's something that you do want to pay attention to, and that can be something that's tied to a situation. Maybe the continuation coverage that you get from an employer helps a little bit with a chronic condition you may have. It ties you to a network of doctors that you may need to see. So that's something that we really want to pay attention to. And then obviously we want to be mindful of the cost there. If you just need insurance in place, I always kind of like to look at the Affordable Care Act for the subsidies. But yes, a lot of people still do have the insurance, but as more people work for smaller companies, it's not always as readily available.
Yeah, and I know you mentioned cost. We've seen cases where, COBRA was the less expensive of the two options, and cases where it wasn't. So it wasn't an automatic, if you have COBRA, take it. I think it's really a case-by-case situation that you have to look at based on where you're located. Would that be the case?
Yes, 100%. I mean, I say, any option that you have at your disposal, there's no bad ideas until you realize that something might be a little bit more efficient for your needs than option A, B, or C.
Yep, that makes sense. And speaking of costs, we found this on a Forbes article. It was current numbers looking at about age 50 that you might expect to pay about $750 a month or around $9,000 a year. But at age 60, you could expect to pay about $1,154 a month. That's almost $14,000 a year. That was for an unsubsidized Affordable Care Act plan off healthcare.gov. Would you say that's in line with what you're seeing?
Yes, as I help people all over the country with this, on average, that's very accurate. Again, those figures are unsubsidized, meaning you're not getting any tax credits to help offset that premium. So that can make something that looks like a pretty daunting number, that $1,000 figure there is never fun to contend with. But as your income goes down, we're always looking forward. It's possible to offset that premium with a pretty healthy tax subsidy if you've done some careful planning.
Yes, I love that concept, and that's what we're talking about next. So, the healthcare tax credit has changed quite a bit in the last few years. These were the old rules, which was what we'll call kind of a cliff qualification. So, these percentages you're seeing related to your income relative to the poverty line. So, if your income exceeded 400% of the poverty level, then you were not eligible for any subsidies. It was like you could go $1 over that limit and boom, no subsidies. But a few years ago, that changed. And so this is the new rule that has been in place since 2021. And it works completely differently. So they benchmark your premium relative to the second lowest priced silver plan. So on the Affordable Care Act, Mike, I believe there's bronze, silver, there's kind of 4 plan levels. Is that correct?
Occasionally, you'll see a platinum level plan, but they are rare. Most states don't have them, but if you do, I come across it every time. But yes, there's a couple of different levels of plans. Fundamentally, the difference between them is the out of pocket cost sharing as you go up in metal level changes a little bit from bronze all the way up to a platinum plan if it's available.
So if you were on platinum, you would expect to pay the least amount out of pocket. And if you were, for example, on the bronze plan, you would expect to have the most out of pocket costs. Would that be about right? Yep.
Correct. Yeah. And that's something that you really want to consider how much you use the plan to, because obviously with the out of pockets being a little bit different from plan option to plan option, if you're not a high utilization person, you may be able to save in some fixed premium, knowing full well that you can cover a potentially larger out of pocket if it did come up, but otherwise you're just paying more in premium for something that you may or may not use.
That makes sense. And specifically related to the tax credits, what these new rules mean is that at most, you will pay for your premiums 8.5% of your adjusted gross income. And so they basically benchmark your plan against the second lowest price silver plan. And they say, okay, at most you will pay 8.5% of that benchmark premium. And so you will get a credit, related to the benchmark premium for amounts above that baseline. Now, if you bought a more expensive plan, of course, you're going to pay that difference. Your credit is going to be based on the price of this benchmark silver plan. Now, a couple things that happen when we talk about this being a percent of income. Income in this case is defined as adjusted gross income, and there's numerous versions of that, but specifically, it's adjusted gross income plus the non-taxable portion of your Social Security plus any untaxed foreign income plus any tax-exempt interest. So for example, if you owned a municipal bond portfolio in a taxable account that would generate tax-exempt interest, you would have to add that interest back. If you had claimed Social Security early, you would have to add the non-taxable portion back in this formula. So it's never simple, but it basically works like this. Based on how that modified adjusted gross income turned out, here's the annual subsidy that you could potentially qualify for. This was based on a 60-year-old couple, and the benchmark plan was out of Hillsborough County in Tampa, Florida. Now, we have had clients that qualified for substantial subsidies that had $2 million, in some cases $3 million portfolios. I know that sounds very bizarre to many people listening, but as Mike said, with proper planning, many people can qualify for these subsidies because modified adjusted gross income is not the same as cash flow. And oftentimes with advanced planning, there's ways to structure your portfolio so that bonds or CDs would mature. And when that matures, let's say a $100,000 CD matures, that's not taxable income. only the interest on that CD was taxable and included in this formula. So there's ways to structure this. We have a client drawing $11,000 a month out. The second of the couple turns 65 next year, but they've been able to qualify for over $20,000 a year in subsidies for the last few years, and it's made a meaningful difference to them.
Absolutely. And one more thing I'd add to that is if you have more dependents that you're still, say you have children that are above 18 but below 26, if you claim them as a dependent on your tax return, that actually aids in inflating the subsidy a little bit. And even if one of the spouses comes off of the ACA to potentially go on Medicare or something like that, they are still counted towards the tax household. So the subsidy still remains in place and everything like that. So that could be really helpful as well.
Oh, that's great to know. Now, another thing that comes up in this pre-age 65 range are health savings accounts. Mike, you want to walk us through the basics?
Absolutely. So I believe in health savings accounts. They're very powerful retirement planning tools that I think get overlooked a lot of times. Basically, they're a triple tax advantaged account that you can open provided that you have an eligible high deductible health plan. So a lot of employers offer those. In addition to that, you can also get them through the marketplace, and there's a few other options to get that qualifying coverage. But it allows you to make pre-tax contributions to an account for eligible medical expenses that potentially can grow tax-free inside of the account. And then when you take it out for qualifying expenses, are tax-free in withdrawal. So it's very helpful. You can save receipts for many years of medical expenses if you don't want to draw on your health savings account and get reimbursed in 1 year, and it's a non-taxable event. So very, very helpful for some income planning down the road. You can use those HSA funds to pay for Medicare premiums in the future from the government, things like that. So it's definitely worth looking into for sure.
Yeah, I love HSAs. I fund mine every year, but I don't use it. I want to let it grow. It's another way to grow money tax-free. So when I see people that fund them every year and then turn around and use them, that's not a bad strategy, but it can be a great way to just supplement your retirement savings by funding it and then not actually using it. You just let it grow, and then we come up with a strategy to use it. It's not the most efficient account to pass on to the next generation, so we do generally like to see people spend these down, generally between about age 70 and 80. Now, I know a question that always comes up is that you can use HSAs to pay your Medicare, your Part B premiums, for example, but not to cover a Medigap policy. Correct, Mike?
That is correct. Yeah, on all the disclosures for those types of policies, they'll say not to be paid with HSA premiums. That is a private insurance contract. It does not receive federal subsidies. Therefore, it's exempt from being able to use that to pay premiums. So yeah, if you're doing that, you want to avoid that.
Yep. And Stefan, another question that often comes up is that you can pay qualified long-term care premiums out of your HSA, but subject to IRS limits. How does that work?
Yeah, so what the IRS has charted out, and they're called age-based limits, depending on how old you are, and it's typically banded, is there's a portion of your long-term care premium that can be either used as a deduction if you itemize up to certain limits, or you can also choose to use your HSA to pay those premiums up to the age limits as well for qualified long-term care plans. And what a qualified plan refers to merely is as long as it's defined under the IRS tax code under 7702B, then it's considered a qualified plan. But there are the ability to use either your HSA or take certain deductions if you itemize for qualified long-term care plans that you may implement.
Yeah, and it's interesting because I haven't seen a lot of that, but then HSAs are still relatively new. So when I think about if people could start funding these early, right, by the time they got to the point where they were purchasing long-term care insurance, like this could be an absolutely wonderful way to cover that premium.
Yeah. And what I do see a lot of, Dana, is basically in conjunction working with somebody's tax professional in years where they can itemize deductions and they qualify under the 7.5% limit. they can just take those right off of their taxes there. And then in future years, they can save those funds inside their HSAs to pay those long-term care premiums. So there's a little bit of a way and a flexibility to choose which option is the best for you. But once again, right, this is all about having the conversation and seeing where we can take each individual.
Yep. Now, I know I have this listed under the pre-65, but just to clarify, you can still cover those long-term care premiums out of the HSA post-65, correct?
That is accurate.
Yep. Okay. And just, for our audience out there, the 2024 limits are $4,150 if you are 54 or younger, and $5,150 that you can put in if you're 55 or older. So you get an extra $1,000 catch up. And then there's family plans. And so the family plan limit, if you had a spouse, on a qualified plan, you can put up to $8,300 in. If you are both 55 or older, you could each put an extra $1,000 in also. So shifting into actually, there was a few other things I wanted to touch on, and it's related to some of the tax benefits. So, Stefan, I know we talked about the ability to pay long-term care premiums from the HSA. Another thing we've encountered, though, is the ability for a self-employed person to deduct these from their, as I believe under the self-employed insurance deduction.
That is correct. So there are certain tax advantages associated with businesses purchasing long-term care coverage for either the business owner themselves or their employees, which for pass-through entities usually might be the business owner themselves and their family. Typically, in general, right, if it's a C corporation, that's where you're going to have the largest tax advantages for those business owners out there. And then depending on the exact structure of the various flow-through entities, there could be additional tax benefits by utilizing the company to pay for those long-term care premium dollars as well. A lot of it is dependent on who the ultimate benefit is flowing towards, whether it's the employees who are not owners, as well as versus if it's the employees who are also owners. So kind of a little it depends situation there as well too. But once again, there may be some tax advantages by implementing a long-term care plan through a business for the owners themselves and or any of their key employees that they wish to cover as well too.
Yeah, and where I've seen this come up, we do tax reviews for our clients, and so we might have someone who's a real estate agent, or they're self-employed, they don't have employees, but they still fall under this self-employed provision, and they forget to tell their tax preparer that they are even paying long-term care insurance premiums. And so that deduction gets missed simply because it never crossed their mind that was information their tax person needed to know. So it's good to pass along, make sure you're sharing these things with who prepares your taxes. The other thing we've seen that flows a little bit more into our next section, the post-65 plus section, is once someone's paying their Medicare premiums, we have seen, again, they didn't relay that information to their tax preparer. They could have deducted those premiums under the self-employed health insurance deduction. Instead, they were taking them as itemized. We actually were able to help one person go back and amend 3 years worth of returns and get about a $7,000 refund because that deduction had been missed for a couple of years. So good to know, you need to communicate these things to your tax person. They wouldn't know to even look for the deduction unless you're letting them know that this stuff is going on.